Hello, everyone. Today is Friday, May 12th. I'm gonna update that, but we're going to be going over the practice test. Um, so let's get started. All right. So the corporation has a $1.4 million investment opportunity with the following characteristics: sales, contribution margin ratio, fixed expenses, and we're looking for the ROI on this investment opportunity. Okay. So if we go over here, we can see the ROI is our return on investment. And the way you get that is you take your net operating income divided by your average operating assets. Uh, I could totally bore you guys with like the actual formulas, but if you don't really understand what it's asking, it's a lot harder to remember and replicate on a test. So ROI is the return, what it stands for. It's the return on the investment, but the investment in this case being the operating assets needed in order to generate the net operating income. So businesses have certain amount of operating assets that they have to keep on their books in order to run things. So in the case of like Safeway, they have to keep inventory on hand, they have to keep staff on hand, they have to keep all the important things on hand, and that has a cost to it. But the advantage of that cost is you get to make money via net operating income. So return on investment is a way we measure how much that return is. Okay, I'm gonna bust out the calculator and we'll get started on this one. So we can do our sales of 4,480,000 times 0.4. That'll give us our contribution margin. And then we'll subtract out our fixed expenses to get our net operating income. So 1,657,600. Then we can divide that by our operating assets. So we got 134,400 net operating income divided by the operating assets of 140,000 or 1,400,000. And we get 0.96. Yes. Yeah. Always good to have that be an answer. So that is the ROI. So you get 9.6% of the money that you put up back. Pretty good. So important thing to remember here too, and this is kind of off topic, but businesses themselves can be investment vehicles. So you usually think of like stocks or bonds as like an investment, but businesses themselves work like that, where they have to, you have to pay the capital up front, but then you get a return on the back end. So it's just a way to make decision making, looking at return on investment. Okay, they're incorporated with the following results from last year's operations. The company had a $900,000 investment opportunity. The following characteristics: if the company pursues the investment opportunity and otherwise performs the same as last year, the combined ROI for the entire company will be closest to. Okay, so we're doing a lot of ROI, which is good because we know that our ROI is just our net operating income divided by our average operating assets. So first, we know that our net operating assets are going to be 3.9 million. Okay. And that's because we invest this much money in the beginning of the year, and that's the average for the duration of the year. So we don't need to find the average between the two or whatever. We're just adding them together because the investment happened at the beginning. Okay, now let's find our new net operating income. So we'll do same process. So we'll do 1,530,000 times 0.6, and then minus 810,000 fixed costs. All right, that's 108,000. And then we can add that to our net operating income, our old net operating income, 456,000. And then we can now divide that by 3.9 million. So we'll just do that on the Excel, but 5, 6, 4, 1, 2, 3. And then if we divide them, equals this divided by this. Okay, and that is 14.46. And we will express it as percent. Cool. All right, that's how you would do it. Okay, calculate the company's margin, turnover, and return on investment. Okay, so well, I could give you the margin equals this over this, I'm just going to tell you like practically what it is. So let's do it right here. So margin, and then we'll have that be the measure of. Okay. So the margin is the measure of like the percentage of sales dollars that are turned into operating income. Okay, so that's how much you make on each product. So it's literally just the net operating income divided by sales. So basically, what we're saying is, and when we divide, we get this, but for every one sales dollar, we have, you know, X amount of net operating income. Okay, and you definitely will have less, which is why it's a percentage because it's out of one or out of 100. Um, because you have expenses you need to take care of that get subtracted out of your sales to get to your net operating income. Okay, so we can just do this. We can divide our sales. We can divide our net operating income divided by our sales. So we will do 441,000. And remember, it's not net income, it's net operating income. Okay. So if we divide the net operating income by the sales, we get 22.5%. And that's expressed as a percentage. It has a percentage right there. All right. Turnover. Okay. We're back. Just making sure that I can see myself. Okay, cool. So going over turnover, that's how many times greater your sales is compared to your average operating inventory. Okay. So that's like the practical definition. But even more practical than that in plain English, turnover measures how much our inventory is turning over. And that's important because you want to see a company that has, you want to see a lot of turnover when it comes to operating assets because that means they're, moving a lot of inventory. If you don't have a lot of turnover, you probably don't have a lot of sales. Or you have a very specific, some very specific clientele that will only buy one or two of your product. Okay, so let's go over the actual the definition. So turnover is equal to um, sales divided by average operating. Okay. All right. So we'll do our sales divided by our average operating assets. And we don't have our average operating assets here, but we do have our sales. So let's get at least one down. So 196 million. Nope. 1,960,000 divided by our average operating assets. So going over average operating assets, we have our assets here, but some of them are not operating assets. So here's how you distinguish between them. Cash is an operating asset. We use it to pay for inventory. Accounts receivable, operating asset. We use it to defer customer payments to us. Inventory, definitely an operating asset. We sell it to the customers. Plant and equipment, definitely an operating asset. We have to have the plant and equipment in order to run our stuff. Investment in another company, not operating assets. So operating assets are only assets associated with companies' operating activities. So doing what the business was set out to do is an operating activity. Everything else financing or something else. They're not included in the calculations. So land also not included. Yeah. Okay. So let's add up these and we'll get our operating assets for the beginning balance. And then we'll find our ending balance, then we'll average the two. So 290 plus 209 plus 282 plus 430. Okay, that is 1,211,000. And the ending balance is 451, 280 plus 193 plus 232 plus 393. Okay, so we have both of our totals now, so we can add them together and then divide by 2. Okay, I got the average operating assets of $1,240,140. All right, these are both in dollars, so I'll make them in dollars. And then we'll divide them. So turnover is going to be just a regular number. It won't be expressed as a percent, mostly because it's going to be greater. That's not 2. That's not 2. Let's try this again. Equals this divided by this. That's not 2. What? I'm doing it on my calculator. 196 divided by 2, 1, 2, 4, 0, 1, 40. That is not 2. It's 1.58. I don't know why it's saying 2 there. Okay, 1.58. So that's our turnover. So our sales were 1.58 times greater than our average operating assets. So that's the relationship between them. Basically, we're able to generate a lot of sales dollars using the inventory that we have, which is good if you want to scale your business. Okay, return on investment. We've been doing this one. So that's literally just your net operating income divided by your average operating assets. We already found our average operating assets. So let's do our net operating income divided by that. So we'll do $441 or 441,000. That's our net income divided by our average operating assets of 1,240,140. And we'll get 35.56. Okay. And then they have a minimum rate of return at 30%. What is the residual income from last year? So residual income is going to be our actual minus predicted. I have it right here. So it's the actual income in dollars minus the predicted income in dollars. So let's find our actual income. Oh, wait, I found it right there, 441,000. Cool. That is our actual income. $8. Okay. And they have a minimum rate of return of 30%. So we'll do our average operating assets times 0.3. Not what I wanted. Average operating assets times 0.3. There we go. Minus the required rate of return dollar amount of 37,2042. Okay, so What so what residual income is showing us is uh how many more dollars did we sell above our rate of return? How much more money did we make above what our initial rate of return or internal rate of return wanted us to make? So we know that we can we have an investment opportunity that we can invest things at 30% in. Um, so when it comes to making decisions on where to allocate cash to this company, uh, you would want to make invest cash because you're able to get it at a higher percentage rate of return, which the 441 is about 35%, and the internal required rate of return or the rate of return we can get somewhere else is only 30%. So we definitely want to invest it in our own company as opposed to somewhere else. Um, so we'll put up the residual rate of return or the residual income of 668,958. Okay. Never a doubt, but I'm cheating a little bit. Just kidding. West Division has average operating assets for 240,000 and net operating income of 42,200. The return is 19%. What is the residual income of August? Okay, well, since you watched my video, I'm just kidding. Residual income, actual income minus predicted. So it gives us the actual income. So let's just write that down. We'll go 42,200 minus the required income. So we'll do 240,000. That's our average operating assets times 0.19. And we had a required rate of return for 56. Okay. And so if we do actual minus required, we get a negative number. And so that means that um, we are $3,400 short of income to get to that desired rate of return of 19%. So we don't want to make this decision because we know we can invest in something for 19%. When if we invest it in our company, we'll probably be making like 18% or whatever, but we'll be losing out on $3,400 to invest in. It's kind of like the Silicon Valley Bank thing. So banks mark their books with unrealized losses like this. So if they can get a rate of return somewhere else that's higher, that's bad for them to have their money in a place where it's lower, because the money needs to appreciate for the banks at a certain rate because money to them is a liability, not an asset. They have to pay it out to their customers, so they need it to grow. But if everyone else's money is growing faster than yours, or um, if you don't have a larger rate of return than all the other bonds, your bonds can be discounted depending on the live interest rate. Uh, yeah, so very fun. Anyway, assume a company reported the following results. The margin is closest to. Okay, so this one's kind of tricky, but it's not really that tricky. So we know that our return on investment is 30%. So we can do our average operating assets of 150,000 times 0.3, 30%. And we get our net operating income of 45,000. And then to get our margin, we can just divide our 45,000 divided by, which is our net operating income, divided by 300,000, which is our sales, and we can get 15%. Never a no. Okay. Uh, More of these, so we'll just do them again. So we're doing the combined turnover for the entire company. Okay, so we're doing turnover, right? So let's do our um, average operating asset or our sales divided by our average operating assets. So it looks like our average operating assets will be 4,700,000, and our sales will be 9,600 plus 2,310. Uh, it'll be 1,191,0. Oh, all right, and we can divide those two. 2.534, like that. Okay, and again, that's not a percentage. That's just a number. So our sales were 2.53 times greater than our average operating assets. So we can definitely generate a lot of sales with that. Also, take a look at this. Contribution margin ratio of 60% is pretty good. That means for every dollar we sell, we get to keep 60 cents. Um, Most retailers operate on like 20% margin if you're lucky. So operating on 60% margins is pretty good. Keep in mind, that's not margin in the conventional sense, that's the contribution margin. So you do have to pay for your fixed expenses afterwards. But it just means that you want to move a lot of volume, right? So it's advantageous to have a turnover like this because for every dollar of invested capital, you get $2.53 in sales, basically. Um, and then for every $2.53 of sales, you get to keep 60% of it. So you can see how these things fast or how they're important for decision making when you okay. Which of the following is not an advantage of decentralization? Okay, delegates the problem to lower level managers. That is decentralization. It enables lower level managers to make their own decisions independent. That's decentralization. It eliminates layers of decision making and approvals. Respond quickly to customers' changing circumstances. That is also decentralization, or that is decentralization. And then it empowers lower level managers to make decisions, which can increase motivation and job satisfaction. Um, it's going to be this one. So they can make decisions independent of each other because decentralization, but that's not necessarily like an advantage of it. Um, Everyone else would be a manager would be um, an advantage. Um, so yeah, that one's a little tricky, but it's just how it is. Okay, missing data, love it. All right, so we already have this. We've been doing ROI until our face turns blue, right? So we're going to be able to just do this. We'll do 800,000 times 0.04 times our margin. That'll get us our net operating income here. Okay, and then for this, like you can double check your work pretty well. So even if I didn't know that it was 32,000, I could find our sales too. So our turnover is five, which means that our sales are five times greater than our operating assets. And again, we know that because we just know the formula. Um, so we're gonna make our sales. We know our sales are 40 million. No, 4 million. Yeah, 4 million. Okay. And so then we can do our sales times our margin to get our net operating income. So times 0.04. Um, that's 160,000. And then we can do our average operating assets times our margin to get our return on investment. Or we can do our net operating income divided by our average operating assets. Okay, and that is 20%. Okay, that's right. All right, so let's do the other two and I'll help. So sales and net operating income. Okay, so I think we can find our margin here, right? So if we have our sales and our ever net operating income, let's check out what percentage of our net operating income or what percentage of our sales actually hits the net operating income. So we'll do 920,000 divided by 11,500, and then we'll get 8%. Okay, and if we know that our return on investment is 20%, um, we can work backwards. So we know that if our ROI is net operating income divided by average operating assets, and we know that our ROI is zero point 0.2, we can then take our net operating income, which we already calculated or which was given to us of 920,000, and then we can create the denominator to be X. So that's what we're solving for. And I'll label it. So we're solving for average operating assets right now. Okay, and then then you can multiply it or you can divide. So um, we'll do so we'll do this divided by this. We'll get 460,000, 4,600,000. Okay, and then our turnover will be the 11500 divided by 4600, 2.5. Cool. All right. And then for this one, we have our net operating income, we have our margin, we have our return on investment. So I think we can find our sales first. So we know that 0.07 is equal to 210,000 divided by X. Okay. So we can then divide 210,000 divided by 0.07. We get 3 million for our sales. Okay. And then if we have our sales and we have our net operating income, we can get our margin and then trying to think what I can do here. Okay, so if our return on investment is 14%, so we can do 0.14, and then we can divide our net our yeah, we can divide our net operating income by 0.14 to get our average operating assets. So we'll do whatever we got here. So 210 divided by 0.14, 1,500,000. Okay, and if our average operating assets were half of our sales, that means that our turnover is 2. Okay, pretty easy. Just kind of got to figure out if you find one, just put them together, find the puzzle. You can move, interchange things. It doesn't really matter. You're not married to only using the formulas from the book, because they can switch. They can go like this, or you can move, right? So if I only knew my net operating income formula or my ROI formula, and I needed to find my average operating assets, here's how I would set it up. I would multiply ROI using order of operations, right? ROI times AOA is equal to NOI, right? So all I did was I multiplied average operating assets to get to the other side, right? And you can move everything around. So if you have two, you can find the third, right? Algebra, uh, you know, I'm more of a geometry guy myself, but whatever. No, I'm just kidding. I was so good at geometry in high school that I got to take it twice. Yeah, it was very good. Before we keep moving, want to go over some memes. Thank you for your submissions or your suggestions. Alex said this one after a few hours of tutoring, and I thought it was the most funny thing I've ever heard. So, like, if there's a fire in your warehouse, the materials are cooked. They're not raw anymore. They're cooked. So yeah, you oh no, I dropped my raw materials into a fire. Oh, they're cooked now, bud. And then special treat if I see you guys. Hey, I better see you guys listening, because if you're not listening, I'm gonna have to. Oh no, I don't want the ad. I don't want the ad. Let's see if I can do this. This is 10 hours of Subway Surfers gameplay that I'm going to put right down here since you guys couldn't behave. No, I'm just kidding. But that's really funny. Yeah, so that anyway, that's the funny for today. Um, we'll throw up some Subway Surfers gameplay while I do some problems. Why not? After all, why not? Why shouldn't I? I love wasting time. That's what I like to do. All right, you get that. Can I pin this? How do I pin this to front? Okay, whatever. You get a little bit of this, and that's it. All right, that's enough Subway Surfers, and he just died. Great. Um, I'm sorry for wasting time. Costs that can be limited to whole part, particular business segment is discontinued are called avoidable costs. Those are costs that you get back. Uh, you can avoid them. So if you discontinue a branch, you get the some of the fixed costs back. You don't get the allocated ones back. You don't get like the cost allocated using your plant-wide predetermined overhead rate. But you do get the ones that are specifically only for that product line. Yeah. Management is considering the elimination of the West Division. If it was eliminated, traceable fixed costs would be avoided. Total common corporate costs would be unaffected. That's what I was talking about. So the way you're going to do this is I like to start out at a negative and work my way back, right? So I want to start at a contribution margin, and we're going to lose out on our contribution margin if we discontinue the West. So first, let's find out how much contribution margin we have in the West. So we'll do 456 or 467,500 minus 222,800. Okay, we get 244,700 contribution margin. We'll make that a negative. So we'll do negative 244,700. And then now, once we have our negative, we can work our way back to positive. So we're going to add back in the traceable fixed costs. Again, costs that we're going to get back, right? So 149,400, right? And we get negative. Yeah, okay. So we get this. So there's two parts to this, right? So that's why I didn't find my answer. But you get negative 95,300, right? So that's our current advantage, our current disadvantage. Um, disadvantage to discontinuing the West. Okay, so this is just the estimated drop in net operating income dollars. But that's if we look at the problem again. that's not what it's asking for. So we're gonna go check that out. So if we just continue the West, we lose on $95,300 of net operating income. But it's what it's asking for us is what is the net operating income of the company, right? So we know what the effect would be. So let's find our old net operating income. So the way we do that, we'll just add the two together. So we'll do 64,000, negative 64,500 plus 46,400. And we'll get negative 18,100. That was our current net operating income before we got rid of the West. Then if we add our negative number back in, and you can do this however you want, but just figure it out. So you're going to add from the negative 18,100, you're going to add negative 95,300, which is the advantage or the disadvantage of discontinuing the West. And we get a larger negative number of 130. No, I don't want Microsoft Edge. Get it off. Get it off. Ah, sometimes it just opens things. Less Corporation produced and sells 13, 8 units, $20 per unit, variable expenses 14. So they showed fixed expenses charged product X would not be avoidable. Okay, so first let's find our contribution margin, right? So we can do $20 selling price minus $14 in variable cost. We get 6. We can do 6 times 13,800. We get $82,800 of contribution margin. And so if we get rid of it, we'll lose out on $82,800 of contribution margin. But we get back the difference between the 73,000 and the 103,000, right? So we get back the 30,000 in fixed expenses that are recoupable, and we get negative 52,800. Okay, so that's the disadvantage. All right, they make this many units, they sell. Okay, so we're looking at the advantage, the disadvantage of buying from the outside supplier. So let's see here. Okay, so for this one, we're looking at the financial advantage, disadvantage of the company buying from outside. So a company has a specific amount of production that it's capable of doing, and you need to make decisions based on that. So do we want to make this in-house, or do we want to free up some space and make it somewhere else? So let's see this. We will avoid, let's see how much costs we will avoid, right? So all the we will it has no salvage value, okay? And all of these would be avoided, right? So we can add them all up since they're per unit, right? So we'll do 6.3 plus 5.7 plus 4.8 plus 7 times 12,000. And then we can subtract out the costs, the avoided costs of 17,000. Okay, and then that's how much it's going to cost us. So it's going to cost us 268,600. And then let's see how much it would have cost us if we bought them. So we'll do 37.7 times 12,000. $452. Okay, and then we can do 452. We can do actually we can do 268,600, which is the cost to us minus the cost that we would pay to the supplier, which would be the 452,400. We get negative Um, okay, wait, let me pause and I'll figure this one out and I'll explain it. Okay, so this is the right answer, and this is the difference between costs from buying it outside the supplier. So what it's saying is it would be cheaper to buy it or to make it in-house, um, because uh, we have a lot of allocated overhead and we have a lot of depreciation that we eat, and both of those are irrelevant when it comes to decision making. Uh, and so we'll have to eat those costs regardless of if we decide to do this or not. Um, but if we do make them in-house, um, they're kind of like already paid for, if that makes sense. Um, because we're paying these costs regardless of um, time, or yeah, regardless of activity level. All right, they sell industrial components. One of its products is known as the PO6. All right, 4,000 as component. Assume that the direct labor is a variable cost. Okay. What is the contribution margin per unit based on the selling price of 220 and its annual production of 400,000 units or 40,000 units? 4,000. Oh, well, I like that we don't have to deal with amounts of units produced because it's asking for our contribution margin per unit. Um, that's nice. Also, if we remember our formula for contribution margin, it's our selling price minus all of our variable expenses, regardless if they're product or period. So we'll do 220 minus 38 minus 1 minus 8 minus 4. $169 per unit. Okay. 8 years annual would be as follows. The scrap value would be 23. Payback period of the project is closest to. Okay, so payback period is literally just the I'll write down here. Payback period is the income, annual income divided by the years. No, annual income divided by the no, I need to get the actual formula. Okay, so I'm back. So here's what we're gonna go over. We're going over the problem again. It's $343,000 for 8 years, and we get $23,000 back at the end. We also get $67 every year annually for those 8 years. So the payback period is literally just going to be our cash inflows minus our cash outflows, right? So we're going to net them together. And basically, the payback period is just saying how long it's going to take for us to get to pay it back using the projected cash inflows. So year 5 stands out to me right here because it's the last year that full period cash flow without going past 0. So year 5 is the last year past 0. So the way we have to do this is we know that our numbers can be greater than 5, right? And probably going to think it's 5.1. But if we wanted to check our work, we would do the difference. So we would do the remaining 8,000 divided by our annual cash flow, our annual cash inflow of 67,000. And that's 0.1. So, not that one. It is, let me figure this out again. Okay, so for this one, it's the cash inflow minus the cash outflow, except there's one important thing. So the depreciation, sorry, the depreciation doesn't get added as a cash expense, right? So when we're doing our payback period estimations, We can do payback period is equal to the amount invested divided by the um, annual. So what I was doing here was this was the net operating income, and this isn't cash inflow. Net operating cash flow. I don't even know if it's right to call it cash flow because depreciation is subtracted out of it, but this is just net operating inflow outflow. Okay, so amount invested divided by the annual cash flow. So the way I solved that was I did 343 divided by 67, but added back in the depreciation to get the cash expense. So it was actually 343 divided by 107,000, and that got us 3.2 years. So depreciation is an expense that we already paid for when it comes to cash. So it doesn't get added. You don't pay for it twice, only once. Okay. Some of the cash flows have from an investment project or reinvestment of the company's discount rate applies to um, only the uh, internal rate of return method. Nope. It's going to be only the net both. Nope. Just one. First try. Yeah, there we go. So yeah, only the net present value method. So the internal rate of return method does use the internal cash flows or the internal desired rate of return, but it doesn't compare it to anything. But the net present value method does when it comes to making decisions. Okay. Corporation offering an initial investment of 350,000 would generate inflow of 132,000 at the end of the project. The equipment would be sold. Company's discount rate is 14%. Okay. So it's 4 years, right? So we can do years here. So 1, 2, 3, 4. And then we can do our cash inflows, right? So it says 132,000 for the life of the project every year. And again, that's in dollars. And then we'll also equals, and then we'll add in the scrap value at the end because that's a cash flow we get back. So 32,000. Okay. And then this is cash outflow of 350,000. And then company's discount rate is 14%. So we'll go to the exhibit and we always want this one. If you open it, here's the way to remember. If you open it and it looks like that, don't touch it. Simple. Simple one is better. Okay. So 14% at a rate of 4 years. So we'll adjust this a little bit actually. So I'm actually gonna have a year zero. Just so I don't mess this up. So 350 3. Okay. And again, that's in dollars. So we'll go here. And then so these are our cash inflows, but they need to be discounted. So basically what we're doing when we discount our cash flows is we're saying what would be our rate of return if we invested this 350,000 at our discount rate of 14%. And so if we have a positive difference, then that means that's good. If we have a positive difference, that means that the cash flow we receive is greater than our internal required rate of return. So that's what we want. All right. And then I'll go here. We'll find 14%. So in year one, it's 0.887. Year two, it's 7.69. In year three, it's 6.75 or 0.675. And then last year, it's 592. Okay, so what I'm trying to stress here is that if I multiply this times this in year zero, we need to invest $97,680 in order to have 165,000 in year four at the company's discount rate. So it's a way to calculate what the present value of that investment is if we invested it at our discount rate. And so if the sum of these is greater than the cash outflows, then it's advantageous for us and we can make money because it's higher than what our discount rate would be. And you can see as we go closer to year zero, our value goes up because as we go closer, we're reducing the amount of time that our 14% return rate affects our money. So we need to put up more and we get less. But for later down the line, we would only need to put up 97,680, right? So like let's say you are investing for like retirement or something and the stock market gives you a discount rate of 7% and that's like the best you can do and it's guaranteed. If you wanted to project your cash flows out like 50 years from now, right? And this is simple, it's not nothing crazy, but if we wanted to project your cash flows out 50 years from now, we can go all the way down here. So in 40 years, we only need to invest $0.067 or basically 7 cents. And in 40 years, it'll turn into $1 at 7%. So good deal if you're very patient like me. Um, no, I'm just kidding. I'm not patient at all. I want my money now. Okay, so that's all that. So now let's sum our cash flows up. So what equals, this will be our outflow, and then we'll get equals again, and this will be our inflow, and our inflow is greater than our outflow, right? So the net present value of this is the difference between the two. That's the amount of money that we're making, 57.63. And my numbers are a little off, but I might have just made a small little calculation error. Was it 350,000? Anyway, I probably just made a little error and I didn't add a percent, but that's what it would be. Okay. I have office hours Monday through Thursday from 4 to 7. So show up to that. You have if you need help. You also have the comprehensive problem due on Sunday. I'll probably have office hours on Sunday. But if I don't, please email me and I can go over it. Okay. Hope you guys enjoy. Remember to like, comment, and subscribe. And I will see you in the next video.